Hey guys, Joel Frank here, market analyst for YouTrading, and in today's video, we're going to be taking a quick look at a couple of trade ideas that I'm monitoring at the moment across markets. So let's jump straight into the video. I've got the S&P 500 here, or a CFD that tracks the price of the S&P 500. One-day candlesticks, and as you can see this morning, just in terms of a bit of a price action update, if we sort of zoom in a little bit, you can see that the S&P 500 had been testing recent highs, had been a pretty good start to the month. We'd gone back above 3,900. We were probing the top of this resistance area, which is sort of between 3,880 and 3,920. But we've now pulled back a little bit and we're pretty much flat slash even kind of in the red now after sort of rejecting this area. Why? Well, I mean, look at this look at these jolts job opening numbers we just got. We're expecting a decline from 10.05 million job openings to 9.75 million job openings in September. But we actually got a massive jump to 10.72 million job openings, pretty much telling us that the continued demand for workers in the US economy is massive, basically. I mean, 9.75 million is still a big number because the number of unemployed people, I can't remember off the top of my head what it is, but it's there's almost two jobs for every unemployed person in the US, even at 9.75. So it's like this just very much in fitting with the idea that the US labor market remains very, very hot. We also got the ISM manufacturing PMI, which is pretty much as expected, 50.2. We're expecting 50. Pretty much the manufacturing sector in the US is in stagnation now, neither growing nor contracting. But yeah, like the main thing here is the hot labor market, which is not what the Fed wants to see. The Fed wants to see the labor market softening. The Fed wants to see growth softening. As bad as that sounds, um, they want to see that because that will eventually lead to lower inflation. And we're just not getting that to the degree which they will want to see yet on the labor market side of things. So that's probably why we gave back those gains, which were, as much as 1% this morning. But the main thing this week is still the Fed meeting, which is tomorrow, and then the jobs data, the official jobs data later this week. So yes, we've come off a little bit on Tuesday, but there's I wouldn't expect to see any real big moves ahead of tomorrow's Fed meeting. And markets seem to be sort of priming themselves for the idea that the Fed is about to slow the pace of rate hikes. They're going to do another 75 basis points um, on Wednesday, the fourth consecutive 75 basis point rate hike, taking rates to nearly 4%, well, 3.75 to 4%, that range. Um, and then after that, the thinking is that they're going to slow things down a little bit. And the thinking is that the Fed's going to potentially message that the tightening that they've already done is they're now seeing that having an effect. So pretty much markets hoping for a dovish Fed. And if that is what we get, an indicator of slower rate hikes ahead, an indicator that the Fed's already happy with some of the tightening it's already done. Because, interest rates are currently at 3%, which is restrictive, then there's potential for this relief rally, I think, to continue. And the area I'm looking at is a test of this downtrend. Let's just zoom out and have a look at it. And let me get it away from my face. Um, we've been in this downtrend since the start of the year, three touches. It's a very widely followed downtrend. Also seems to quite nicely coincide with this September high around 4,150. If we get to that area, whew, I will. I don't know, let's see what happens. But I think that could be a nice area to sell potentially if you've still got the hot US labor market and you've still got US inflation, which is like particularly core inflation, which remains well above the Fed's target. If those two factors remain the case, then we could still be talking about the Fed lifting interest rates above 5%, which for me isn't, you can't get a sustained bullish breakout, on back towards record highs or back towards March levels or whatever, if you're still talking about inflation being high, US labor market being hot, and rates being above 5%. I think if that is the discussion, then we're going to be talking about actually moving back lower again. But anyway, that's what I'm watching in the S&P 500. A couple of other things I'm looking at. What's going on there? Let's get the dollar index up. There we go. That's what I want to look at. Dollar index seems to be in a bit of a modest downtrend at the moment. Makes sense. We're talking about a slightly more dovish Fed. Risk appetite has been improving with equities rebounding pretty strongly from the lows they hit earlier this month. So yes, looks like we could continue to see the Dixie moving lower within this downtrend. Um, I'm thinking if we get a test of this support area, that could potentially be a very, very nice area to be getting involved again in terms of longs. Like I say, there's still a risk that US inflation, particularly core price pressure, is going to remain elevated for quite some time. It doesn't look like the US labour market is slowing down enough yet to justify a more long-term move lower. So that's why I'm thinking about that. But anyway, guys, those are just two of the things I'm looking at today. Hope you enjoyed the video, and I will see you all in the next one.